trend.
And Mark, let's talk specifically about titanium, because if I look at the breadth of your business, of course, you have titanium technologies, thermal and specialized solution, and advanced performance materials. It seems like the titanium business was the odd man out here.
It is, and it's really tied to a slower recovery. That business was down quite a bit in Q4. When we planned for the year, our expectation was we would have a much stronger second half based on China coming back online and a few other things. It's just a slower recovery. We did see improvement in our volume sequentially. Our volumes were up 13%, but it's just a slower recovery than we were otherwise expecting. And we made a difficult decision in the quarter to adjust our capacity with the announcement of a plant closure in our fleet to drive better alignment between our capacity and demand we see going forward.
Do you anticipate that you'll need to take more actions along those lines, more plant closures, for example?
Not at all. In fact, this will really get our fleet of plants which use lower cost inputs such as lower quality ore grades in titanium dioxides, and that really puts us back on track. So the focus here was really to get our titanium technologies business, back on more solid footing, as we move forward, while really driving the growth in our thermal and specialized solutions, which had a record quarter, and our advanced performance materials, where a part of our polymers focused on advanced electronics and clean energy were up 17% year over year.
So when we get to sort of, I guess, the other side of all of this, Mark, particularly when it comes to renewable energy, renewable sources, and all the components that feed into that here, is your company actually positioned genuinely to take advantage of that, or do you run the risk of ending up, I guess, with, for lack of a better phrase, a legacy business?
Absolutely not. We are investing as we speak in expanding our Corpus Christi facility by 40%. We've permitted a new plant in France to meet the demand for Nafion membranes in the hydrogen economy, and we're expanding our plant in West Virginia to make more Teflon PFA, which goes into semicon onshoring. So, the team is incredibly focused on how we drive the company forward. And you may have noticed today we actually announced the launch of a new specialty fluid called Opteon 2P50, which is focused on the immersion cooling needs for data centers, and is a really good play into the so-called artificial intelligence boom that we see happening in the marketplace right now.
The growth that you're trying to create here, Mark, do you think that most of that growth will be organic in nature, or do you anticipate M&A?
I would say today, Romain, most of it is being driven organically. We did in the last quarter enter into a joint venture in Germany that's focused 100% on membranes for fuel cells. This is again in the hydrogen economy. And what people tell me is you're one of the lowest cost investments in the clean energy, whether it's hydrogen or advanced electronics or AI, in terms of our play in making chips, in chip fabrications, as well as, immersion cooling, which will be huge in data centers.
All right, Mark, got to leave it there. Really appreciate your time. That is Mark Newman. He is president and CEO of Chemours. Now, still ahead, a recent surge in chicken wing prices has Wedbush changing its tune on Wingstop. We'll talk to the analyst behind the call next. This is Bloomberg.
on the next episode of The Circuit.
I was like, this is a way to change culture. Like, what a different world. Of course, we know for girls, it means so much to have female athletes to look up to, but for boys, to look up to women also, it's really for everyone.
Watch The Circuit with Emily Chang Thursdays, 10 p.m. Eastern on Bloomberg Television, or 8 p.m. Eastern on Bloomberg.com or the Bloomberg app on connected TVs.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We would be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
Breakout we have all perhaps long awaited, finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Let's get agreed on from the sell side with our top calls, the big movers on the back of analyst recommendations. And we're going to start off with Wayfair. The home goods retailer upgraded to overweight over at Piper Sandler. The price target almost tripled to 97. The analyst there says the online home furnishing retailer is on the cusp of sustained EBITDA profitability. He cites the company's improved relationship with suppliers. Shares of Wayfair up 6% on the day. Next, let's take a look at Adobe, upgraded over at Morgan Stanley to overweight, and a street high price target now, a 660. The analyst saying that he has greater clarity on the company's AI-enabled products and the monetization roadmap. Clarity that increases his confidence in a re-acceleration of Adobe's Creative Cloud organic growth. Those shares up 3% on the day. And finally, let's take a peek at Ford here. Getting cut to hold over at Jefferies, which says the downgrade comes with a heavy heart amid a strategic wobble as losses at Ford's electric cars mount. Shares of Ford down 1% on the day. And those are some of our top calls. Let's stay in the sell side space here and take a look at some of the big earnings up this week. Apple, Amazon, and Wingstop. Yeah, Wingstop. It's going to report second quarter results on Wednesday, but Wedbush says rising chicken wing prices present some risk for the restaurant chain as we head deeper into the second half of the year. Nick Setyan joining us right now. He is Wedbush's Securities Managing Director for Equity Research covering restaurants, and he recently downgraded Wingstop to neutral from outperform. And, well, Nick, a big part of that call was the rising cost of chicken wings, something I hadn't kept an eye on, but they're up pretty dramatically just over the past few weeks alone.
Yeah, they are, and usually when wing costs are going up, Wingstop's share price tends to either stagnate or go down. So I just think we're in for a period of underperformance.
So give us a sense, though, of why that underperformance is. And when we talk about the increase in the cost of wings to Wingstop and ultimately for the franchisees, is there a sense here that those costs will be passed on to the consumer?
Yeah, so wings are between 20 and 45% of their wing of their total food basket, depending on the price of wings. So, coming off of all-time lows, wings were about 20% of their food basket. We think it could go up to 40% plus of their food basket again, just given the volatility and the magnitude of historical moves in wing costs. And so when that happens, franchisees tend to increase prices, more than the advisable ahead of corporate sort of advice. And that tends to impact transactions, and usually the share price follows. Now, this is in the context of 20% comps in Q1, mid-teens comp in Q2. So there's already a lot of nervousness in terms of how they're going to be able to anniversary those comps going into the first half of next year. And you add the uncertainty around wings on top of that, all of a sudden that wall of worry just continues to build.
Talk to us about how seasonality factors in here, because you're right in your note that if you think about the demand going into March Madness, for example, that's a time when wing costs tend to rise. When you think about the price pressures that we're seeing now, is that an anomaly at this time of year?
Yeah, usually wing costs don't tend to go up this early. They start to go up into the football season, the start of football season, and peak during the Super Bowl, stay steady, go up a little bit into March Madness, and then you see a little bit of a seasonal downtick after that. So the fact that we're already going up tells you that the supply-demand dynamic has shifted. We had chicken breast prices that were at all-time highs, and so we had a lot of supply of chicken, come online. And now that, chicken breast prices have declined, you're seeing that supply shrink a little bit. On top of that, you're seeing the demand return in terms of, dining out, et cetera, the bar and grill segment. So, as we go into next year, I just think this is going to continue, particularly as we go into the seasonally stronger period.
And Nick, we don't have much time left, but I think that's a really interesting point, the return of dining out. We were talking about this a little bit in the context of Domino's. It seems like Wingstop is one of those restaurants that doesn't necessarily benefit from a return to normal, if you will.
Yeah, I mean, the overall context of return to normal doesn't necessarily benefit the delivery, restaurants. Wingstop has been very successful in sort of Wingstop-specific drivers of comp, like the introduction of the chicken sandwich that is driving a lot of the comp right now. But ultimately, now that's in the rearview mirror, we don't see too many big catalysts ahead of us as we anniversary those very big comps.
All right, Nick, I really appreciate you taking time for us here. We'll keep an eye, of course, on those earnings, absolutely, when they come out a little bit later this week, though. We should point out shares up a decent amount today, up about 2.5%. Coming up here on the big program, a sit-down with the founder and CEO of Our Crowd. An interesting discussion here about the judicial reform going on over in Israel and the impact that the outrage over that could have on venture investing. That conversation coming up after the break. This is Bloomberg.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Welcome back to Bloomberg Markets to Close. It's time now for our Wall Street Week daily segment. David Weston, the host of Wall Street Week, joins us as he does every day around this time. And David, you always have some great interviews on Wall Street Week, but one that I'm kind of interested in is there's been all this hubbub going on over in Israel over judicial reform. Yeah. But we kind of forget there is kind of a business fallout to this as well.
Exactly. Yeah. At the core of the Israeli business, which has been the startup nation, as you know, Romaine. Yeah. So we actually tried to figure out, was it affecting what's going on with venture capital over there? And we turned to the man who knows it better than anyone. He's John Medved, our crowd founder and CEO. He has been the most active venture investor in Israel for each of the last 10 years. So we talked to him about exactly what effect all this was having on his business.
The coverage of it is well overblown, but I want to explain a little bit about how it works. Israeli companies are never really Israeli companies. They start in Israel. We're incredible at innovation and creating new things and starting companies. But more quickly than most anywhere else, we send our people abroad. And these companies morph into U.S. companies, European companies, Asian companies. So for many, many years, we've opened up either subsidiaries or parent corporations in Delaware. It turns out that Israel has a strategic relationship with Delaware. And so today, as a result of sort of the political turmoil, there have been more companies, significantly more, who are flipping that now and saying, you know what, let's set up the Delaware parent. Okay, that's probably a risk-adverse option, and we'll have the Israeli be the daughter or the son company with the R&D activity. But this is nothing new. Now, in terms of cash, most of the cash that comes into the Israeli ecosystem, the billions and billions of dollars, even today, that are still being invested, comes from overseas. So as much as 70 to 80% of the venture capital invested in Israel is overseas capital. And they're always comfortable if you park it overseas. Now, a lot of it used to be parked at Silicon Valley Bank. And Israel, was very much part of all that. Today, not so much. But on the other hand, what's happening is that today, when there are choices to take these cash reserves and to distribute them in an intelligent way, there's more attention on that. And people are hedging their bets and keeping their money in the country to pay their teams and whatnot, but in terms of reserves, very often keeping them abroad.
So John, when you talk and deal day in and day out with venture investors, but also with CEOs of some of the startup companies, how important is the uncertainty over the rule of law involved with this judicial reform? Because back here in the United States, again, we hear a lot about CEOs get nervous if there's uncertainty about the economy or about what's going on legally. Is that a chilling effect right now? And what do you need to get past that in Israel?
So, look, the bottom line is that Israeli law is absolutely alive and well. Our democracy is alive and well. The question is much more, where are we going with this? So the government passed a resolution that, in my opinion, should have been better negotiated and brought to a consensus. I think that anything that touches sort of semi-constitutional or, sort of the rules of the game should always be done, not on a couple of seat majority. But let's face it, this government's a legitimate elected government. They chose to do this under great duress to the high-tech community, by the way. The high-tech community has been leading, by and large, the protests against this judicial reform. But what was passed now was simply a matter of whether or not the courts can use the doctrine of reasonableness to disqualify laws. The courts can still disqualify laws for corruption, for equality, for all kinds of other reasons. But the fear is that this is just the beginning of a much greater assault on the judiciary. Now, what's interesting over the next couple of weeks is you're going to see the judiciary itself ruling on whether or not this law is reasonable or, kicks in. What's fascinating about this is how the world is being brought into a rather arcane and interesting judicial debate. It's as though the world was focused on U.S. Supreme Court, not issues like Roe versus Wade, but on how the court actually adjudicates. And it's great that people are into it here. Look, what I'm most proud of is we have hundreds of thousands of people taking stands in the streets, shouting democracy. This is a thing of great pride to me, and I'm very proud of my comrades and colleagues in the tech community who have felt that this is more important than anything, that we need to make sure that we stay a vibrant democracy and that any assault on the democracy here is something that should be resisted.
And finally, John, let me broaden this out, if I could, to your area or your region, because before there were all the questions about the judicial system, there have obviously been questions about your relations with your neighbors. And we had the Abraham Accords that seem to be making good progress forward. We now read that maybe there's some disenchantment now with UAE. The UAE is not so happy with it. At the same time, the United States reportedly is trying to really bring Saudi Arabia into the camp. How important could that be for venture investing if, in fact, the Abraham Accords go beyond where we are right now, even to Saudi Arabia?
Well, look, if the Abraham Accords expand in the Saudi Arabia, this is hugely important. We're very active in terms of this historic reconciliation. The Abraham Accords, in my opinion, are nothing less than the breaking down of something like the Iron Curtain in Eastern Europe. I liken it to the Sand Curtain, which is now blown away, and it's never going to be built back. And there might be, and there often are, ups and downs in these relationships. People, feel better and less better about how things are going. We have announced a $60 million investment project where we're investing in Abu Dhabi, and we're building artificial intelligence and advanced software. I was just there a couple of weeks ago with our incredible team. So we're, all into this. But if the Saudis join, and I've been a couple of times in the kingdom myself over the last year, this is going to be a completely wonderful and very exciting opportunity. I really wish President Biden and Prime Minister Netanyahu all the blessings and encouragement to make this happen. I think this would be not just a great thing, for our business environment, but for humankind and for really restoring the Middle East to its rightful role as a center of fertility, both in business and in good relations, and really becoming a center for goodness as opposed to a center for conflict.
That was John Medved. He's Our Crowd founder and CEO. I found it fascinating just to see how it's affecting their Silicon Valley, their startup nation over there, because we read so much about the turmoil.
Yeah, great interview there, and I thought the way he ended it there was very apropos.
Yeah, it was pretty uplifting if it could actually happen. And now we're going to take Wall Street Week on the road.
Whoa.
And yeah, we're going out to Aspen, Colorado for the rest of the week. We'll be broadcasting from the Aspen Economic Strategy Group meetings. We'll be talking with leading economists and business leaders, including Fed Presidents Raphael Bostic and Austin Goolsbee, former chair of the President of Biden's Council of Economic Advisors, Cecilia Rouse, and Brian Moynihan, chair and CEO of Bank of America.
All right, definitely something to tune in there as we lap up here for the final hour of trading on this Monday afternoon.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenivek on Bloomberg Radio.
Live from the Bloomberg Interactive Brokers studio, streaming on YouTube and Bloomberg Originals. Hello, Maddie Mills.
Hi, Tim Steno.
This is Bloomberg Business Week, Monday, July 31st, 2023. That voice you heard just now is my co-host, Madison Mills. Carol Masser, finally getting a little bit of time to relax.
Thank
Everybody
God
deserves
for
a vacation.
Yes, but I'm so glad that you are back from what was not a vacation, what was paternity leave, but we missed you so much,
Well,
so I'm happy you're here.
This is our first show together back, and I'm excited because it's going to be a really good one.
I know, we've got a lot to talk about today.
We do. Stock's really not doing much today, but how about this month? S&P 500, close to a 16-month high. Not inflation adjusted, okay? Go check out MLive for some cool stuff from Dan Curtis and the team there about why you should think about this in an inflation adjusted basis. But also on pace for its 5th consecutive monthly advance. More on the markets and the economy in just a minute. Maddie, what else do we have on the agenda
Well, we've got
today?
this story that you flagged this morning, Tim, about the trucking firm Yellow telling workers that it's shutting down. This leaves 30,000 people without jobs. So big question when it comes to the unions. We're going to get our very own Kriti Gupta in to talk to us about the earnings story there, the union story rather. And then speaking of earnings, we got to talk tech.
We do. We have Apple and Amazon happening this week. We're doing a tech roundtable, though. Do you still send X's, send tweets? What do we call this thing now?
I'm refusing to emotionally cope with the rebrand.
Yeah.
I'm just ignoring it and shoving the rebrand down.
You know what marketing experts say? They say if everybody knows about a brand, definitely change the name to something nobody's heard of.
Exactly.
Yeah, definitely.
Elon loves X. We know this.
He loves it.
He loves X as a letter, as a term. So there
Well,
you go.
Kanye's back. We're going to talk about that as well. We're doing a deep dive on real estate this afternoon as well. And then this is a really cool story. Investors are bullish when it comes to women's professional soccer. It's in Business Week, so we're looking forward to that one too.
I love this story, and it's so part of our growing coverage of investors being bullish on sports. You know what I mean? There's pickleball we're always talking about. Last week we talked about
fastest
Top
growing
Golf.
participant sport in the U.S., pickleball, that is.
Are you doing it
I've
yet?
never played it.
I feel like you would be an absolute
Well, I played
celeb.
tennis in college, so there's kind of this thing that there's kind of this thing where if you're used to play tennis, you don't really play pickleball. I think
Got
there's
it.
like
There's a rivalry.
There's a rivalry, yeah.
Okay,
Yeah.
but you could own the pickleball space.
It's hard to find courts in New York.
Yeah, that's true.
It is really hard.
That's true, Tim. That's
All right,
true.
well, we don't go anywhere because all that and more to come. First up, though, we're going to bring in our TV colleagues because Bloomberg's Countdown to the Close starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostic alongside Katie Greifeld. We're joined right now by our colleagues, Tim Stenivek and Madison Mills. I always have to wait till they pop on the screen because I never know when Tim and Carol are just taking off willy-nilly here. Welcome to our audiences across all of our Bloomberg platforms on the final trading day, Tim and Madison, of the month of July.
What a July, right?
Yeah, absolutely. And it was better than a lot of people expected. Remember, everyone said rally was over after June. They were wrong.
Did you really go to Beyonce over the weekend?
No, I went last weekend, the previous weekend.
Oh, you did? I didn't realize
In
that.
Chicago.
Oh, yeah. Okay, never mind.
I should have been asking you for tips.
I felt like I was the only one who didn't go to Beyonce over the weekend.
Well, you
here.
missed
I
out.
wasn't there either.
In
It's
New
all
York.
right.
That's where all the discussions, we actually solved, believe it or not, the inflation conundrum.
What was it?
I don't know, I can't tell you.
Okay.
But I
we
can tell
were
you,
spending,
Beyonce has lifted her inflation target.
Okay.
Yes, especially, Romaine, you traveled. You're like the perfect example of consumer resilience with the Beyonce story.
That's right. I had little sparkly tights on and everything.
Okay, well, you went to okay, we got to see pics of this. We're gonna look for those. Check out Romaine's Instagram for all of those details.
Hit me up on X.
You want to no.
CNBN, Romaine Beyonce.
I'm old enough to remember when it was called Twitter. I want to talk a little bit about AI though. Because, when I was telling someone last week I was headed back to work, they said, you better hurry up because AI is going to replace you soon. And I said, maybe soon, but not so soon. These big companies, they can't replace us yet, right? At least that's what I tell myself.
No, what we do is so valuable to humanity. I don't think so.
Well,
keep thinking that, Katie.
Yeah. To your point, Tim, though, I love the optimism. I love the optimism. But Bloomberg surveyed 13,000 workers and said that more than 85% of employees believe that they need training to address how AI is going to change their jobs. So we're starting to see firms offering up training, some of them making it required, others making it kind of optional. If we had the training, I mean, I'd be doing it.
Yeah, I mean, look, I mean, this is all coming for us one way or another. It's just a matter, I think, Katie, of how we manage it. Of course, no one could ever replace Katie Greifeld.
No, I feel totally comfortable, but we'll see. I mean, we were just having a really interesting conversation, actually, with the Sweetgreen CEO. Of course, they have automated kitchens. And on a serious note, we asked him, is this going to replace human workers? And eventually we did get to the answer, and the answer is yes. So that'll be interesting to watch.
That's the holy grail for all these companies that actually employ people. I mean, that's why Uber for so many years worked so hard on self-driving cars, because
so if they use AI, I don't understand how they. So it's just robots making the salad. So it's just like bag salad. I mean, can I just go to the?
You didn't watch the video on YouTube? There's a whole video on YouTube.
I did not watch the video.
Yeah, I was watching it in the commercial break.
Robots.
It's pretty spooky. Let's talk about something else. This is a painful topic that have a rate. They have a rate below 6%. So these would-be sellers are just sitting on their houses. They're not selling because they don't want to lose that rate.
Yeah, I mean, this has been a big topic of conversation because, like I said, I mean, we kind of forget that this is always a two-way street here. But Katie, right now, I'm just looking on my phone right now on one of the popular home buying apps here. There's actually something right across the street. It's just a cool, what is this?
How much?
5.6 million.
Ooh,
it's not bad. It looks spacious. Looks like it has
think
good
about
light.
your commute and how much money you'd save on lunch if you could just run home.
Yeah, you just stop buying all those $20 Sweetgreen salads and avocado toast, Katie. What are you doing?
I'll crunch the numbers. I'll get back to you guys, but it seems a little steep.
There you go.
All right.
It's right here, Katie, if you want.
Thank you. We'll discuss offline.
You guys are going to have to survive for the next 50 minutes without us.
Yeah.
But don't worry, because
are you
we'll
going to be back? Where's
We'll be back. We'll be
Okay.
back. She's on vacation. Everybody deserves a
You're stuck with
vacation.
me.
We're back together again, live on TV, radio, and on YouTube, also on Bloomberg Originals at 4 p.m. for our Beyond the Bell coverage when we take you through today's market. Be changed.
Thank you.
I don't know how to, I guess a transition I could use is that we're having a party here in the studio this afternoon. And we have a full house here because we got a couple friends with us this afternoon because we're talking about the markets, we're talking about the economy. Speaking of the economy, we've got a lot going on when it comes to this week. July payroll's coming Friday. We got JOLTS before that, ISM manufacturing, we got more. The Bank of Japan announced unscheduled bond purchase operations to buy debt. And oh yeah, just last hour, we got the old senior loan officer opinion survey from the Fed. Then we got what's going on with the markets. S&P 500 up close to 20% year to date. Even the bears are becoming bulls right now. To get a lay of the land when it comes to the global economy, we've got Bloomberg International Economics and Policy Correspondent Michael McKee with us and Deputy Team Leader for U.S. Equities, Jess Menton, in the studio as well. Mike, I want to start just by talking about the Senior Loan Officer Opinion Survey from the Fed that we got in the last hour. Any surprises in here?
No surprises. The surprise was I didn't turn my microphone.
Surprise!
Surprise! When you say the Bears, I always want to say "da Bears," but I'm figuring Maddie won't know that either. So.
All right, we'll have to do a pop culture. We'll do like a pop culture happy hour sort of thing with Maddie later.
We'll do a round table. Yeah.
You would expect financial conditions to tighten, credit conditions to tighten when the Fed is raising interest rates, and they have. We're up to about 46% say that they have tightened somewhat. Only 4.8% say they have tightened significantly. That's up in both categories a little bit from the April survey, but not a huge amount. And it does show the Fed is accomplishing what it set out to do by tightening credit. That's the whole point of the interest rate increases. And we're seeing loan demand fall, not crater, but drop a little bit, and that's what their whole goal is to bring demand down, so take some of the pressure off of prices.
Well, hold on. It's not working when it comes to residential real estate. We just talked about that, and I know this is not
weird. Yeah, it's a whole weird.
I know this is total. I'm totally throwing a curveball at you, but we were just talking about this. We're going to be digging into real estate a little later in the program. We're in this gridlock right now, Mike, and Fed Chair Jay Powell talked about this last week, and he pointed to new supply coming online. But if you're not buying a brand new home that nobody lives in yet, you're not finding a home.
Well, that's the unusual situation we find ourselves in, and it's unusual because people have gotten used to very low mortgage rates. Back in the Volcker days, if mortgage rates were 17% and somebody offered you a 5% mortgage, that would sound like a great deal. Now, if somebody offers you a 5% mortgage, you're like, I'm at 2, 2, 3. I don't want to, sell my house. So we're seeing people sit because they don't want to trade in their mortgages. And there have been various proposals over the years to change the way mortgages are done here in the U.S., including the idea that more of them could be assumable. If that were the case, then you'd be seeing a lot more real estate, and maybe that's something people would get back to if and when things don't get better. But other than that, we really have to wait for interest rates to come down, which they're not going to do for a while. And the thing is, when you own your own house and you're selling it, that's not the same as a builder, because the builders have been buying down some mortgages for people. Right. So unless you've got a lot of extra cash sitting around, you're not going to buy down your buyer's mortgage.
Yeah, it makes me wonder to what extent the Fed moves matter if they aren't impacting people's mortgages, though, which I've been wanting to ask you about. But Jess, I want to bring you in here. You had a great weekender, and one of the quotes in there that I loved is one of the people you spoke with said that the market is moving on any soft data, but anything else they're just pleasantly ignoring.
Right.
So what does that look like?
Well, also, when you look at what stocks have been doing this year, they haven't been quite as correlated with some of the macro data, like the inflation data prints that we would have seen with CPI last year. Not surprisingly, right, because the prints have come down so much. I mean, CPI has been cut more than half since its peak in June of last year, which is right above 9%. Now, far below that, too. But in general, July tends to be a very strong month historically, and it's lived up to that reputation. So if you look at where we could potentially close today, that would put the NASDAQ 100 up for 16 consecutive years for the month of July. And so the question being, as you go into what's typically the weakest months of the year historically in August and September, whether that momentum can continue. But usually seasonality, it's kind of one of the buckets that investors and traders are obviously looking at, but also positioning and clearly sentiment and how much more room could go. But it seems like when I'm speaking with my sources, if some of them are concerned, it's more they feel like, especially when you look at the strategists on Wall Street, a lot of them are starting to capitulate either with their targets or their rhetoric. And I know that Tim had a question about that.
Yeah, Jess is looking at me because I saw her in the pantry a little earlier, and I said, I leave for a few months, and it's enough time for like the most prominent bear on Wall Street,
right,
Mike Wilson and Morgan Stanley, to become a bear on Wall Street, to become a bull. What's going on with this reversal?
What's interesting is it's a lot of reversal in his rhetoric. So last week he said, hey, we made a mistake. Today he had another note out talking about how he feels like and his team think that the rally in the S&P 500 could continue, but they still have a year-end price target of 3,900. They haven't changed that yet. So that still would be a drop of about equivalent around 15% from where the current levels are. But you are starting to see them change that type of tone. And then you've also heard Marko Kolanovic. We're actually trying to wait for a note from clients today, but last week he kind of had a similar tone change as well, but still felt like, hey, there could be a sell-off at some point, which we all know eventually there will be. But you're starting to see more strategists capitulate like that. Also, Piper Sandler is typically the most bearish among the firms on Wall Street, but they raised their target from a little bit above 3,200 to a range around 3,600 and 3,800, which is well below, right? We're trading above 3,500 right now. But you are seeing more and more strategists. So the question is, when do they all completely throw in the towel? And where's that a contrarian indicator for the broader stock market?
Well, I can tell you that Albert Edwards is still bearish.
Right.
I don't think he's ever been bullish. But
and then you'll have the Tom Lees of the world who will always be perma-bulls too.
Yeah, Albert is still suggesting we've got a bubble in the stock market.
Well, then on the eco side, Mike, to what extent do the market factors, something like Amazon earnings or Apple earnings, become eco data that should be leading the Fed?
At times that happens, but I don't think it's happening right now because so much of it is expected, and so much of it is tied to things that are not under the Fed's control. If demand, I mean, the consumer-focused companies are of more interest to the Fed, but if demand falls or if earnings fall, say, because fuel costs are up for transportation, well, that's not something that's really being affected by the Fed. So they're not looking at that. They are looking at whether or not people aren't buying stuff, and that's why earnings are lower. But we've seen basically a lot of companies say things are all right from the demand side. It's the cost side that we're having to deal with.
I'm really glad that Maddie just asked that, Mike, because I was wondering about Yellow and the trucking company that we learned, according to the union, will be ceasing operations. 30,000 jobs. That's a lot of jobs.
That's a lot of jobs, but there are something like 600,000 trucking and warehousing jobs open, according to the last JOLTS report. Now we got another JOLTS coming up. So in theory, those people could be absorbed relatively quickly. There's questions about, a lot of them are union members. 22,000 of them are union members, so I don't know how easily they switch over to a non-union job because a lot of these carriers are non-union. Sure. But it is not a major impact, it doesn't appear, on the trucking industry, or at least the transportation industry, because there are other trucking companies, less than truckload is the kind of trucks these are, and they have the capacity to pick up a lot of the business, and they've already picked up a lot of the business. One of the weird things about what happened to Yellow is you get into a death spiral because shippers think you're not going to be around, so they start moving their shipments to another trucker, and then you're not going to be around because nobody's shipping with you, even if you're fine.
And that's the end.
And they weren't fine. Yeah. So that it doesn't seem to be a major impact on the economy overall.
Really quickly here, Jess, for the rest of this week, what is going to move the trade more? Some of these big earnings or some of the eco data?
I would take a look at how the protection cost in the markets is actually the lowest since 2008. It's something that Elena Papina, one of our star reporters on the equity team, is watching closely. So I think things beyond even just some of the stuff we've been discussing.
All right. Really interesting stuff. Thank you both so much, as always. We've got Bloomberg International Economics and Policy correspondent Michael McKee, and of course, Deputy Team Leader for U.S. Equities, Jess Metten, who I'm seeing IRL after spotting you at the Barbie movie last night.
Doing what you guys can do to support the economy.
Absolutely. Absolutely. Thank you both so much for joining us. Stick with us here for more coverage from myself and Tim Stenovic. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:21 on Wall Street. We do check markets all day long here at Bloomberg. We are looking at a mixed market, little change, choppy session. S&P right now down 3 points, a drop there of just about 1/10%. The Dow higher by 8 points, little changed as well. NASDAQ up by 2 points, up by less than 1/10%. 10-year yield right now 3.96%, with a 2-year that's yielding 4.87%. Spot gold up 0.3% to 19.65 the ounce, and West Texas Intermediate crude oil up 1.7%, 81.94 a barrel on WTI. Wall Street is looking ahead to Friday morning's jobs report and what it might tell us about the Fed's efforts to quell inflation. Kathleen Boschanczyk is chief economist at Nationwide Mutual Insurance.
The question at the same time becomes, if the labor market remains very strong and GDP growth still is outpacing underlying potential growth rate of the economy, does it make it much more difficult to get inflation to move lower from where we are now? And that's the key. Can they actually get down to 2% over the medium term?
And you can hear more of that conversation on the Bloomberg Markets podcast. You can download it wherever you get your podcasts. So again, recapping here, we've got the 2-year 4.87%, with the 10-year 3.96%. S&P lower, little change right now, down 3 points, a drop there of less than 1/10%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Thank you, Charlie, and welcome back. We missed you. It's good. Oh, you might hear the echo there of Charlie because his mic was off, but he was
welcoming you back.
Oh,
exactly.
Thank you, Charlie. Well, the trucking firm Yellow Corp told workers that it was shutting down. That's according to its union, jeopardizing 30,000 jobs as the historic freight brand faces heavy debt loads and operational woes. This company is the third largest less than truckload carrier in the U.S. So that means that it uses a warehouse network to combine several smaller shipments on one truck for short-haul deliveries. It's different from long-haul trucking in the parcel industry, those UPSs of the world, which carries individual, usually smaller packages. Very pleased this afternoon to be joined by Thomas Black, Bloomberg Industrial Logistics and Aerospace reporter. He's been all over this story. We're also joined by Bloomberg anchor and markets correspondent Kriti Gupta, who's also been all over this. It's good to have you both with us. Thomas, I wanted to start with you and just give us kind of the latest, because we're still reading that it's the union that's communicating this, not Yellow.
That's right. Yellow hasn't made it official yet, but all the expectations are they will declare for bankruptcy. There may be some legal issues. They're still shopping around their 3PL business, which is a business that coordinates freight and doesn't have trucks. So I don't know if that's slowing things down, but we haven't heard from the company. But the union knows this is happening because the company has shut down operations and workers are no longer going to work.
Well, bankruptcy doesn't always mean that a company shuts down operations, that a company stops what it's doing. I mean, there are plenty of bankrupt companies that continue to have operations. What's going on with Yellow?
Yeah, in this case, trucking's a little bit different because you can get your product stuck in the system. So when the operations are under stress like this, customers tend to flee, and at some point, they have closed operations. They are no longer picking up freight. So we do know that.
All right, so Kriti, come on in here because I know that you are following the labor story for several companies right now so closely. Talk to me with Yellow specifically about what the back and forth looked like between the union and the company and what the kind of sticking points were.
Well, we know that the Teamsters union negotiations have really kind of set the tone for labor negotiations across the country when it came to what they demanded from UPS, the major shipper. And this included things like eliminating the two-tier wage system, giving benefits, time off. But of course, pay was at the core of it, especially because a lot of these workers, I mean, they're truck drivers, they're manual laborers. This is a very intensive industry, and they weren't getting paid necessarily by the same rate depending on how many hours that they worked. UPS has really ended, or the Teamsters negotiation have really ended that dynamic. But Teamsters also represents a lot of workers at, say, Amazon, for example, and Yellow, among others. And the Yellow story is really interesting because they had tried to negotiate an agreement with this, by the way, I should say, what used to be kind of a name brand logistics company, and of course has declined since. But they ultimately, I think what you need to know here is, had negotiated a $50 million increase of a payment from Yellow to their employees, and their Yellow's company finances got so bad they weren't even able to make that payment. Ultimately, Teamsters said, look, we're going to strike. And even that didn't pan out simply because there's no money to go around.
Well, the company also really kind of put the blame on the union, saying that the union efforts hurt a plan to combine its trucking divisions for Yellow. What is Yellow's standing on that, and how does that play into the overall picture that we're seeing in the infighting between unions and these companies?
Yeah, well, I think it really speaks to kind of the pattern that I think Yellow has developed. And I mean, Thomas can speak, I think, probably better to this, but essentially this idea that a lot of their financial troubles have come simply from trying to acquire other pieces of the logistics space. And in doing that, that kind of consolidation, which again is very normal when you're trying to gain market share, has ultimately led to these major debt issues. Add on the higher wages of workers, and specifically what the Teamsters are adding for, and that is an additional cost. So you are seeing this kind of double-barreled whammy, if I will, on kind of how they're able to deal with these.
I'll allow that, Kriti. I'll allow that. Thomas, I want to bring you back in here and talk a little bit about the other companies that might be the beneficiaries of Yellow shutting down. XPO Logistics, Old Dominion, for example. From the perspective of customers, is that where they fled?
Yeah, the LTL market is a little bit more concentrated, a lot more concentrated than the truckload market. So there are a handful of large players. FedEx, for example, has an LTL business. There's another company called Sai, and the ones that you mentioned. Those are really the dominant players in this market. There's some smaller ones, but it's concentrated. So those companies have had a decline in their volumes, just coming down from the pandemic highs. So they have excess capacity, and they are absorb up, the freight that will come to them. They probably will try to cherry pick it a little bit to make sure they get the most profitable part of that, or the freight that matches up with the lanes that they tend to run. So we're going to see that being divvied up. I would say on the union talks, the company actually came to the union to ask them to reopen the negotiation. Their contract had run through into next year, but they wanted to do this consolidation of their different units to gain some efficiency. So they reopened that contract, and the negotiations didn't go anywhere. And that $50 million payment was a payment that they owed for the pension. And when they couldn't make that, that's when the team decided to pull the plug on their negotiations. Now, whether it's the fault of the Teamsters or not, I don't want to make that call. Certainly the company says that's the case. I would just say that the Teamsters, besides the UPS contract, did negotiate contracts with ArcBest freight unit called ABF Freight, which is also an LTL carrier. And they they're about to ratify an agreement with T-Force, which is the LTL carrier that UPS sold a couple of years ago. So it's not like the Teamsters aren't doing agreements. This one, I think, was maybe an outlier.
Okay, that's good to know, Thomas. Kriti, I want to bring you back in here because you and I were chatting about this a little earlier about what you thought sort of the most interesting element of this story is, and it's one that struck me as well. It's the fact that pretty much everyone listening, if they're a U.S. taxpayer, they're owners of this stock. Taxpayers own 30% of this.
They are. The irony is that the stock is a penny stock now. It doesn't even really hold that much value.
So the taxpayer should have shorted it, is what you're saying.
I mean, I do not give investment advice.
Thank you.
Come on. But yeah, I think that's my favorite fun fact kind of about this whole story is that, look, because of these big financial troubles that Yellow has gotten into, well, they ended up procuring about a $700 million loan in 2020 when a lot of businesses were getting that kind of COVID relief. The idea that under the Trump administration, he used these national security measures to make sure that supply chains were working, that everything was kind of trying to function as best as it could, just given the dynamic there. Under that, Yellow had gotten a $700 million loan that they still have not paid back. So they basically owe the Treasury Department $700 million. And in doing that, by extension, taxpayers own about 30% of the stock. I think, though, one of my favorite kind of things to put into perspective here is simply that when you look at their long-term debt, that $700 million loan represents nearly half of it.
Wow.
It's a lot. So again, when I say that they're in some serious financial trouble, taxpayers are paying part of it.
All right, final 30 seconds here, Thomas. Is part of the takeaway from this story about overall freight demand declines post-COVID?
I would just say Yellow is an outlier. They've had financial problems really since the Great Recession back in 2008, 2009. So they have been battling financial difficulties for a long time. So I wouldn't read too much into their particular problems for the freight market. Freight market is depressed a little bit, but the strong carriers are going to be able to power through.
Really good stuff, guys. Both of you, really appreciate that. That's Kriti Gupta, Bloomberg anchor and markets correspondent, and the voice you just heard there, Thomas Black, Bloomberg industrial, logistics, and aerospace reporter. Both of them have been all over this story, so we really appreciate it. Maddie, as Thomas was just speaking just now, I thought back to the comment that Michael McKee made to us a little earlier, which is that 30,000 jobs, that's a lot, but as we'll see in JOLTS data, hundreds of thousands of open jobs for these drivers who find themselves no longer working for Yellow. We're going to dive into that and more after the break. You're listening to Bloomberg Business Week. Let's get a check on the latest world and national news. Nancy Lyons is in the Bloomberg 99.1 newsroom in Washington, D.C. Hey, Nance.
Thanks, Tim. Ukrainian President Volodymyr Zelensky is likely to travel to New York in September to attend the UN General Assembly session. He's expected to make the case for his peace formula plan. That's according to those close to him. Among the conditions he's proposing is for Russian troops to withdraw completely from Ukraine and to release all prisoners and deportees. Well, as for the status of the conflict in Ukraine, Bloomberg's Roz Matheson is in London and says at least 4 were killed, 42 injured in a Russian missile strike in Zelensky's hometown. She says the ground offensive is slow going, though, so both sides have moved to the skies.
Russia primarily targeting Ukrainian grain infrastructure in the south around the Black Sea port area with missile and other attacks, and of course the attack today on Volodymyr Zelensky's hometown. And in turn, Ukraine supporters, because Ukraine doesn't officially claim these things itself, seem to be sending increasing numbers of drones into Russian territory.
Again, Bloomberg's Roz Matheson reporting from London. The property manager of Donald Trump's Mar-a-Lago estate made his first appearance in a Florida courtroom today. Carlos de Oliveira was indicted by a grand jury last Thursday on charges including conspiracy to obstruct justice and making false statements to the FBI. De Oliveira did not enter a formal plea during today's hearing because he has not retained a Florida-based attorney. John Irving is his D.C.-based attorney.
We're working on that. Should have it done fairly soon, it's my hope.
Attorney John Irving, de Oliveira will be arraigned August 10th in Fort Pierce, and he has been released on a $100,000 bond pending the trial. Paul Rubens, best known as Pee Wee Herman, has reportedly died at the age of 70.
I'm in your living room!
He died last night after a private 6-year bout with cancer. Global news 24 hours a day, powered by more than 2,700 journalists and analysts.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:40 on Wall Street. We do check markets all day long here at Bloomberg. The Dow, the S&P, NASDAQ 100 index, all in the red right now. The Russell 2000 is higher. But let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. That's right. U.S. stocks in the red, but quiet today with the Dow only down 6 points. S&Ps are also down 6. And NASDAQ is lower by 8. The U.S. 10-year yield at 3.96%. Gold is up 6, oil trading in the green, but Bitcoin is down by 0.2%. Of the main 11 S&P sectors, leaders were energy and real estate. Healthcare and consumer staples were under pressure. And leaders to the upside in the Dow, Chevron and Disney, while J&J fell 4% and led to the downside. After earnings, SoFi jumped 20%. And in other news, Exxon is in talks with Tesla and Ford on supplying lithium. In deal news, Francisco Partners and TPG to acquire New Relic for $87 a share in cash. And wrapping things up, some of the names reporting after the bell tonight include Arista Networks, Western Digital, and Transocean. Live from the first breaking news desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill Maloney. And to hear live breaking news over your Bloomberg, type Squawk SQUA on your Bloomberg terminal. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
You drive me crazy.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
You know what I've just realized is, Tim, you were on pat leave during the massive AI rally. So you got to miss saying AI 20,000 times.
You know what's great?
Broadcast.
I get to keep saying it.
Yes,
because
that's great.
This AI rally continues.
That is so true. Call it AI euphoria, the FOMO rally, a classic bull market, whatever you want to call it. The market has obviously been on a tear driven by that exact AI rally. It's set for its longest streak of monthly gains since August 2021 for the S&P. So as always, with too much of a good thing, you got to wonder, when are we going to start to see the cracks? And that's exactly what I want to ask our next guest. We've got Vivian Hairston, Director of Portfolio Management at Huntington Private Bank, joining us on Zoom. Vivian, thank you so much for being with us. We're seeing that stock exposure for traders at record highs, and the rally really driven by that magnificent seven big tech names. Is there kind of a scary catalyst looming out there that you are anticipating and that could start to kind of turn this market?
Well, thank you for having me. I won't say that there's a scary catalyst. We are cautiously optimistic regarding markets. Really looking at the consumer remains strong, and so markets and the economy both, we're cautiously optimistic. Of course, the Fed did raise rates just by 25 basis points, no surprise, last week. But we, in looking out next 6 to 12 months, we're saying perhaps now that there's maybe a 55% chance that we'll see a recession. But overall on markets, again, as you just mentioned, looking at equity markets, they've been very strong.
They really have.
I'm sorry.
Well, I want to go back to the 55% chance that there's going to be a recession. Is that Huntington Private Bank's view?
It is.
Did that change last week after you heard Fed Chair Jay Powell say that even the own internal economists at the Fed are no longer seeing a recession as their base case?
Actually, we became a little bit more cautious before the meeting. And it was, looking at the markets, and really after that June meeting, of course, Chair Powell was very hawkish And so last week, of course, dialed it back a little bit, not as pessimistic it seems, but we reduced our equity weightings a little bit before the Fed meeting, just looking at where domestic equity markets have been. I really just thought it was best, to lock in some of those gains.
When you think about the recession call, I wonder to what extent you feel like company earnings are part of that calculation. Are you looking at earnings that we're going to get this week from the likes of Amazon and Apple when sussing out the strength of our economy?
Well, we did consider the fact that earnings in the first quarter came in better than expected. Of course, those earnings were better than expected on lowered expectations. And what we're hearing now is we're beginning to hear some earnings revisions coming down again, forward earnings coming down again. And so we are kind of, again, just being cautious. We've seen so far, I think the expectation coming into the quarter was down about 9%. And what we're seeing, I think, is somewhere about 9.2. And so that does provide us caution.
And I noticed that you trimmed your equities holdings by 10% and added to fixed income, which I'm so curious about. It feels like you're really getting paid to go into fixed income right now. How much are you changing your thinking on allocation between stocks and bonds there?
So we actually trimmed by 5% our equity holdings, and then we took that 5, and you are correct, and we added it to fixed income for a number of reasons. Of course, fixed income is finally attractive after 20 some years, and so now you're seeing those yields on fixed income and cash above the inflation, and so that third leg of the stool is available to investors. And we just thought, looking at domestic equities again, looking at those returns, some of those returns we'd be happy to have had just for a year, let alone 6-7 months into a year. And so we thought it was prudent just to take some of those gains off the table.
So it raises the question about somebody who comes to you right now with a few $1 million. Let's say they had an exit. They want you to deploy the money for them. They have a time horizon of, they've got a long time horizon. This is money for later. Are you comfortable putting money in equities right now?
We are, and really not just right now. If we kind of take a look back, that 5% yield on cash is very attractive, and one might be tempted to perhaps hold the money in cash. But really, as you mentioned earlier, the returns that we've seen in equities, they've been relatively narrow. Of course, we've seen that leadership in those 7 tech, consumer, or communication services companies. So now what we're beginning to see is really that performance begin to broaden out, whereas communication services, information technology is still leading year to date. What we're beginning to see is a little bit of broadening. If you use energy as an example, up about 7% so far this month.
Sure. And in our final kind of 45 seconds with you here, I want to talk about some of the stocks you've recently added. And in our note here, we have Adobe, American Express, T-Mobile, and Netflix in that list. Talk to me about your thinking on Netflix, because the earnings picture was not great, particularly in the market reaction.
Well, really, again, just thinking about the consumer, and my area of expertise isn't the individual companies. We have a wonderful research team that could probably talk a little bit and go a little bit deeper. But again, looking at consumer trends, of course, Netflix earlier changed their model a little bit in terms of how they were going to be charging clients or feeing clients, not sharing those passwords and like. And so we anticipate that they will begin to see a turn and some better earnings.
Vivian, we're going to have to leave it there. We really appreciate you taking the time this afternoon. Vivian Hairston is a director of portfolio management at Huntington Private Bank. She joins us via Zoom this afternoon. Taking a look at the markets just about 10 minutes before they close. The S&P 500 down 0.2%. The Dow down fractionally. The NASDAQ down about 0.1%. Don't go anywhere. Our countdown to the close is coming up in just a few minutes. This is Bloomberg.
Your company news headlines on Bloomberg Radio.
From Bloomberg World headquarters, I'm Charlie Pellet. Salad chain Sweetgreen shares are now up by 7% after it was upgraded to overweight from neutral at Piper Sandler. Last week, you recall, Sweetgreen raised its outlook after posting better-than-expected results for a key gauge of operating profit. Jonathan Neiman is the president and CEO, and he was interviewed on Bloomberg Markets.
We're really proud of the quarter we posted. We had 22% year-over-year growth, 3% comps with positive traffic, and we expanded our restaurant level margin above 20%, delivering our first profitable quarter on an adjusted EBITDA perspective as a public company. So I think a sign of more things to come. Companies focused on disciplined, capital efficient growth as we continue to bring our mission across the country to more cities and more locations.
And you can hear more of the conversation on the Bloomberg Tape podcast. You can download it wherever you get your podcasts. Two big high-profile earnings reports later in the week. Amazon and Apple. Anurag Rana, a senior tech analyst at Bloomberg Intelligence, says services will be in focus at Apple.
When you look at the Apple story, the products, the iPhones, all of them combined have one gross margin, let's say sub 40%. But while you look at the services gross margin, that's in the 70s. Right. So as services become a bigger portion of the overall pie, Apple's gross margins have to improve.
And ahead of the close, we do have Apple shares up now by about 0.1%. Apple reports Thursday, as does Amazon. Amazon shares up now by 0.9%. Those are our top company stories at this hour, and this is Bloomberg.
This is Bloomberg Business Week with Carol Messer and Tim Stenivek on Bloomberg Radio.
It is Bloomberg Business Week. Tim Stenivek joined along with Madison Mills as Carol's on vacation this week and maybe a day or two next week. Maybe. I want to talk Taylor Swift, Maddie.
Oh, yeah.
Did you you saw Beyonce?
I had to pick, I had to make tough choices, and I got to be honest, it wasn't that tough for me. Beyonce is my
so
ride
it wasn't
or die.
it wasn't even like a.
It wasn't even a question. But also, to be honest with you, there was no world in which I was getting Taylor Swift tickets. Like,
were they that
it's
much
just
harder
so
to get
impossible.
than Beyonce tickets?
Well, I had a friend whose dad had a credit card, so that's how I got in on Beyonce. But what's interesting,
I don't know what the story is. I'm not going to ask for details.
I'll give you all the tea. But what's so interesting is I was talking to our eco team about doing a story about how Taylor Swift's tour was adding to U.S. GDP and how that was going to be bad news for the Fed. And then the Fed scooped me and came out with a report about how Taylor Swift was fueling GDP growth.
I think there were details in the beige book, correct me if I'm wrong.
Yep.
And then last week, Jenna Smilik at the New York Times asked the question specifically to Fed Chair Jay Powell and referenced, I believe it was Taylor Swift and Beyonce too, and maybe the Barbie movie was in there as well.
Yeah, just resilient consumer overall. Yeah.
Well, okay, so that brings us to this opinion column by our own Jonathan Levin. Yeah. Taylor Swift hype disguises tame event spending. So the Eras Tour, Barbenheimer, and resurgent baseball attendance give the impression of booming recreation outlays. In reality, it's mostly post-pandemic normalization.
Mm-hmm. Yeah.
So, yeah, go ahead, Maddie.
No, it's just, even on the Barbenheimer story, it's been so clear when looking at kind of domestic receipt sales that movie theater attendance is still, I think, 19% lower than pre-pandemic levels. So we're getting closer, but still not at the pre-pandemic levels when it comes to that consumer spending on experiences like going to the movies.
How was the Barbie movie?
I mean, I saw it twice, Tim.
Oh, really?
Yeah.
So last night was not your
first time? It's a feminist manifesto. I mean,
my dad dressed up in all pink to go.
Really?
Yeah, I'll show you a picture. It was really funny.
When are you going to go?
When I can find babysitters.
Right, I know.
That's when I'll go.
Yeah,
I mean, babysitters, plural.
You can stream it. You know what I'm saying?
Can you stream it now? You can't stream it now.
But in like
that's
6
when I'll go.
months. Like, do you need to watch it?
Okay.
You got a newborn,
That's true.
Yeah.
Well, stick with us. Coming up next, we're going to be joined by our Bloomberg TV team for our cross-platform coverage on radio, TV, YouTube. Also, of course, on Bloomberg Originals. We're going to be counting you down to the close. Bloomberg's Beyond the Bell starts right now.
Good song.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Scarlett Fu. We're counting you down to the closing bell, and here to take us beyond the bell. It's our global simulcast with Madison Mills and Tim Stenivek. Welcome to our audiences across Bloomberg Television, Radio Originals, and our partnership with YouTube. Maddie, interesting day in the markets here. On a daily basis, pretty much a mixed bag here as we close out the month of July.
Yeah, but still seeing the AI euphoria fueling some of the green that we're seeing on the screen, which I'll get to in a little bit. But seeing the likes of Palantir hitting 52-week highs today, it's just a reminder to me that this AI euphoria we've been talking about for so long is not necessarily in our past here.
So I said this earlier on radio, but I leave for a few months, I come back, and Michael Wilson at Morgan Stanley is a bull now? That's what happens?
I think so. I mean,
I think he's conceding defeat.
That's true. That's a good point, because I guess he still does have a year-end price target of 3,900 for the S&P 500, but at least for now, he's ceding defeat. That's true, Scarlett. Thank you.
It's more a case of you can't fight the rising tide, right? I mean, the market has gone every which way against what he had predicted, and he's now looking at patterns close to 2019, which would suggest more gains to come.
Yeah, and I think, a lot of people are making a big deal out of the mea culpa here, but as you pointed out, his price target is still well below where we are, and even he still seems to be kind of planting those red flags that he planted a while ago, saying that that's still coming, maybe just not as soon as what he had originally sort of written into some of his market commentary here. All right, we get the closing bells here in New York on this Monday afternoon. The Dow Jones Industrial Average higher by about 0.3% on the day, and it's going to close out the month higher by about 3%. The S&P 500 higher by about 0.1% on the day and 3% for the month of July. The NASDAQ Composite closing out the month of July with a 4% gain, only about 0.2% came here on this Monday. Meanwhile, the Russell 2000, that was your outperformer on the day, and believe it or not, it was your outperformer on the month, up 1% on the day and 6% on a month-to-date basis.
Yeah, it's interesting. Matt Maley put it well in his note this morning. He said, is avoiding a recession going to be enough to push the market higher when it's already expensive? And if the market does continue to trade kind of relatively sideways here, Scar, I wonder what the fuel is going to be moving forward.
Right. Well, one thing we are looking at is rising oil prices. Certainly in today's trade, WTI above $81 a barrel, and that is lifting the energy stocks as a group. That group is up by 2%, with 21 out of 23 members higher. You also have gains in consumer durables and apparels. That is Hasbro, Ralph Lauren, Nike, and the retail companies as well. That's Etsy. On the downside, pharma stocks off by 1.25%, and then you have food, beverage, and tobacco. So that is consumer staples losing about 0.8%.
All right, well, I want to talk about some of the green we're seeing on the screen today, starting with Adobe reporting better than expected results, up by a little over 3% on the close here, raising full-year revenue as well, and announcing the introduction of pricing for some of their AI tools to come this year. One of those is going to include legal assurance against copyright infringement claims for some of their creative products. So that's going to be huge for a lot of the creatives that rely on Adobe services. Moving into more AI coverage, as I mentioned earlier, Palantir hitting their 52-week highs today, up by a little over 11% on the close. The CEO saying the demand for their new AI platform is without precedent. We're going to get those second quarter earnings in just a couple of weeks here, actually August 7th. And then I want to talk about SoFi, up by the most in a year after boosting its adjusted EBITDA guidance, citing benefits from deposit growth. They've got a really competitive rate of return, so seeing a lot of inflows on the deposits there. Also interesting, they're expecting an uptick in their student loan refinancing business, which is obviously going to be huge for them as those student loan payments begin again, Romaine.
Yeah, let's just take a look. We're actually getting some earnings crossing the wire. This on Avis Budget, ticker CAR. The shares were up a couple percentage points in the regular session here. Adjusted EPS coming in for the second quarter at about $11 per share. That's a big beat versus what the street was looking for, which was about $8.30 here. In line with estimates on the revenue side here. And just taking a look here, when we talk about some of the individual metrics like the number of rental days, a decent little beat there as well as on some of the adjusted EBITDA figures. So a little bit of a mixed bag here, but overall, some of the key metrics, they appear to have beaten the average of what the street was looking for, Tim.
Yeah, Romaine, while you were going through the numbers, I was going through the press release, and Avis Budget's group CEO said that summer travel has continued to be robust with elevated peak period demand and seasonally improved pricing. That's certainly a bright spot, especially after hearing from some of the airlines last week that domestic travel has pulled back a little bit. We'll hear from JetBlue later this week and perhaps get some more color around that. Let's get to some of the decliners, some of the red on the screen this afternoon. I want to start with Johnson & Johnson, falling the most since June of 2020 after a judge dismissed the second attempt at using a unit's bankruptcy case. What this would have done is press tens of thousands of cancer victims to drop their lawsuits and accept a close to $9 billion settlement. So over at JP Morgan, Chris Schott says that it looks increasingly likely that the talc litigation will continue to be a cloud over J&J as it looks to update a settlement structure or begin litigating about 100,000 remaining cases. Ford falling 0.4% today. This after Jefferies cut it to hold with a, quote, heavy heart following results last week, which saw worse than expected losses on EVs. And then this is an interesting one, XPO Inc. At first, you might want to say that shares of some trucking companies like XPO fell today after Yellow Corp told workers it was shutting down. That's according to its union, we should note. But we should note that this was really well telegraphed, according to Thomas Black, who covers Bloomberg Industrial Logistics and Aerospace reporter. Yeah. This was more so a result of actually just it was cut to neutral over at Credit Suisse from Outperform. So I think that's why it was lower.
Yeah, there does seem to be a little bit of a disconnect there, at least when it comes to the catalyst for why that moved down. Let's take a quick look what happened in the yield space. Not a whole lot. We talk about just how tepid the price action was in equities. Similar story in treasuries. And in fact, on a monthly basis, I was just taking a look. I mean, you actually made money on a price basis in the fixed income space, whether it was on sovereign yields or in corporate fixed income. But overall, it would kind of just round trip. There was so much volatility in between, but I mean, you look at a 2-year yield, just to cherry pick something, we're basically at 4.9 right now on the 2-year yield. That's pretty much where we were right around at the start of the month, right? Just above 4.9. So a little bit of a downtick from 4.93 to 4.88 if we want to be specific, Scarlett.
Yeah, if you just look at the monthly change, not a big deal, but certainly the movement during the month has really raised a lot of people's eyebrows. We also have earnings coming out from Western Digital, the hard disk drive maker, reporting operating expenses. Actually, you know what? Let's start with the bottom line number here. Adjusted loss per share of $1.98. That is narrower than what analysts were looking for. They were expecting a loss in excess of $2 a share. And when it comes to revenue, $2.67 billion, beating the average analyst estimate of $2.5 billion. And let's get to operating expenses now. Higher than what analysts were looking for, $742 million. The consensus estimate was just under $729 million. So as a result, the gross margin goes down to 3.9% from the consensus estimate of 4.01%.
Yeah, Scar, and some encouraging commentary from the CEO in the statement here saying we're encouraged by several indicators signaling improving flash market dynamics. Our two largest end markets, client and consumer, are returning to growth. Inventories are normalizing. Content per unit is increasing. So very much so bad news for the Fed on that statement, but definitely seeing a growth story when it comes to what the CEO is saying there.
It's interesting so far. I mean, most of the earnings we've gotten, I think, have been better than expected. I mean, with the caveat, of course, that we know that expectations had come down. So that sort of proverbial low bar, if you will. But this is the week where we start to get, I think, a much broader swath of companies, not just the techs and the financials. You get, you know, the Caterpillars, you get a lot of healthcare companies. You get a much better sense here of where spending is, but also more importantly, where some of these companies see their own spending, meaning their own investments, R&D and CapEx as well. And I'm kind of interested in seeing what those companies have to say later this week.
Yeah, big question certainly has to do with that CapEx and to what extent these companies have pulled back on making those huge investments. And I'm also really interested, and I know you said not necessarily tech, Romaine, but I'm already looking forward to Thursday.
What's that?
When we do hear from Apple, when we do hear from Amazon.
Okay.
Yeah, those are pretty important.
Is Amazon seen as a tech company?
Amazon's a tech company.
It's
yeah,
a tech company still.
Is it?
Yeah,
It's all
consumer
about the cloud.
discretionary, I
It's
guess,
in
is what
consumer
it's
discretionary.
characterized as, but you know, they want you to value it like a tech company.
Is it though? I don't know. I mean, it's like everyone told me Tesla was a tech company, and it turned out it's just a car company.
Yeah, a very valuable car
You
company.
go tell that to Elon Musk.
I
He'll challenge you to a
I
case
did,
battle.
but he kicked me off Twitter or whatever.
It's not called that anymore.
Yeah.
X.
I didn't get reinstated. So I don't know. Everyone else got reinstated. Have you
Are
seen
you
the people that have
I
been
think you can
reinstated?
get reinstated if you're willing to pay for your blue check mark.
Yeah, you can get reinstated by doing a lot of stuff that isn't quite kosher here. In all seriousness, though, I mean, when we talk about the idea of sort of what the read is on the economy out of some of these companies, Scarlett, I mean, do you think that Amazon is going to give us a better read on that, or Apple? What?
I mean, those two companies are so far away from the rest of corporate America because of the amount of cash that they have at their disposal, the levers that they can pull. So, you know, to your point, Apple and Amazon don't necessarily give us a read on the U.S. economy, the rest of corporate America, but they give us a read on what the biggest companies and the most well-endowed companies have at their disposal.
Yeah,
and the choices they're making about how to manage their cash.
No, well, to your point, that capital allocation is really interesting. And with the AI story, I always think about whether we're seeing companies misuse their IT budgets and whether they're going to pour a lot of money into AI that they could have been spending on typical IT expenditures. Why are you laughing at me, Romaine?
Because we already know where this is going. In a few quarters, we're going to start seeing the write-downs for a lot of companies that had no business chasing after this AI nonsense. Look, there are companies that will benefit, NVIDIA's and Amazon's and a lot of those companies, but there are a lot of other ones that have been trotting out all this spending on AI that are probably going to have to go ratchet that back.
I'm still thinking about the metaverse.
The metaverse.
Oh, Tim,
I'm still thinking about the
You
metaverse.
and Mark Zuckerberg.
You were gone for a
RIP.
couple months. All right.
RIP metaverse.
With that, I am so sad to say that this
You should start
conversation is
your own
over.
show, Tim, called Meta IRL. How
You
about
two,
that?
too close to home. That's going to do it for our cross-platform coverage of the market close on Bloomberg TV. We're going to be back tomorrow, same time, same place. Thanks for chatting, guys.
And on Originals.
Of course. producers on this show.
We do. Romaine was joking a little earlier in the program about looking up a nice, nice little condo across the street from here. It could be yours for over $5 million, but imagine how much money you'd save on your commute. You wouldn't have to pay the $275 each day for a Metro card.
That's true. But
Yeah.
what would happen to Sweet Green without me needing to go there every day for lunch and being able to go home? It would tank the company.
Well, it probably isn't news to anyone who's been looking at real estate over the last year. It's never been more challenging to find an affordable home to buy in the U.S. High prices, a critical shortage of listings, mortgage rates that have more than doubled from the record lows of just a couple years ago. That's forcing countless Americans to put their next move and other major life decisions on hold. Gridlock is gripping the housing market. So writes Paulina Cachero, Bloomberg personal finance and investing reporter. We've also got with us this afternoon Bloomberg senior U.S. economy team editor, Alexander Tansey, with us, because he's got a great piece on what it takes for someone to actually part ways with their home. So, Paulina, I want to start with you. Give us an idea of just how bad it is out there.
Yeah, I mean, if you're in the market for a house, you probably know that one of the biggest issues facing the U.S. market right now is a lack of inventory. Never before have home hunters been faced with so few choices to choose from. And it's not just that. They're also faced with massive affordability issues. As you mentioned, mortgage rates and borrowing costs to buy a home have doubled at the fastest clip in a decade. And home values have, ballooned during the pandemic buying frenzy. So if you're looking at these three major factors, it's been really, really tough to buy a home. And, I think that builders are rushing to step up the production and, because the reason why we're seeing home prices still haven't fallen is because there's a huge gap in supply and demand. And largely absent from keeping the turnover in the housing market moving is homeowners who are willing to sell. Right. And I think that a lot of people forget that people who would potentially list their homes and add to the market are also looking for a place to move. And so that's where we're really seeing this gridlock in the housing market. People aren't finding, there are a lot of homeowners that want to move, but they simply have nowhere to go.
Right. Well, and they want to hold on to their mortgage rates if they're a little bit cheaper there. Alex, I want to bring you in on that exact question, because the thing that I can't get my head around is if the Fed is trying to cool down the economy by raising rates, how can that be an effective move when it's making people hoard their houses long term? And we're seeing this continued gridlock here. Please explain that to me.
That's a massive problem for the Fed because they can't break people's contracts with their mortgage. So
right.
And people don't want to leave their house. So if you have a 3% mortgage or less, which a lot of people do, it's really tough to swallow to dive into an almost 7% mortgage.
It is, but there's always going to be those instances, Alex, of divorce, of families getting bigger, of people outgrowing their residences, of people dying. This always happens.
And you have massive amounts of boomers retiring, and they might want to live somewhere else when they retire.
But they don't want to move yet, right?
Well, not necessarily, but a lot of people have, 40% of homes are free and clear.
Wow.
So even if they, they can take that cash and maybe purchase 100%, mortgage free somewhere else that's might be less expensive.
But Alex, one more for you, and then we'll go back to Paulina. Why hasn't that been happening at the rate that's been, typically happens when people do retire, when they do downsize, when the kids move out of their houses?
I mean, a lot of older people have a lot of wealth, so they can just purchase a new place and keep the old and spend a few months in each.
Maybe the kids live in the other one, right?
Yeah, something like that. But, again, it's hard if you have a mortgage and you're paying, 2.75 or something. It's really tough to give that up.
Right. Well, and it's a great point that you brought up, Tim, that these life factors are always going to happen. And I know, Paulina, you spoke with some sources who had that exact story, going through divorce, needing to move. Talk to me about their experience.
Yeah, so I think that if you look at, obviously, holding on to a low mortgage rate has been a huge economic benefit for a lot of current homeowners. They've also, ostensibly have benefited from the boom in home values. But, when faced with the prospect of actually moving, they're finding that the homes in their neighborhood have also risen. They're also finding that, as we mentioned before, the borrowing costs would double. So even though people are having, these life stages where they would typically move, they're putting pause on those decisions and those, those moments in their lives because, when they're looking at the financial calculus of moving, they're finding that it might cost them more to move, even though they have benefited from all of these really amazing things, that we've seen in the housing market in the last
Paulina,
couple years.
When does this new housing stock that Fed Chair Jay Powell was talking about last week actually come online? Because he was asked about this, the supply and demand imbalance that we're seeing. It's going to come from new construction, and is that going to actually make a dent in this? Is that going to help?
I've talked to a couple of housing experts about this point, and, construction alone is not going to fill the gap that we've seen in the market. It's going to take homeowners who are willing to list their homes. And actually, we cited a report from Credit Karma that 67% of homeowners are willing to wait until mortgage rates drop. If you're sitting on a really good, mortgage rate, there's no reason for you to move. So people are just delaying and are willing to delay for quite some time.
Okay, but Alex, if mortgage rates drop, then that creates more demand for homes. And doesn't the cycle just continue? Because then everyone's like, oh, we're going to be ready to move. So everyone starts to move. And then we see 2020, 2021 all over again, where low mortgage rates were leading to high prices.
I mean, prices are up a lot, and they're up a lot more than income. So people's monthly payment is a lot higher than it used to be. So I don't think we would see the same thing. I mean, 3 years ago, home prices were half what they are today. So, people's monthly mortgage was much less.
Do you have a timeline that we can hold on to, Alex, for when mortgages might start to drop? Just about 20 seconds here. I'm asking for Tim. I'm never going to own a house. I mean, this is never going to happen for me, but for Tim, I'm curious.
A senior economist at Zillow in the piece today, he doesn't see a likely return to 5% anytime in the near future. So, they could be up high for years. So one possible benefit is some people were in adjustable rate mortgages, and if those rates start adjusting upward, it might force some people to downsize.
I don't like the sound of that. It goes back to 2006 and 2008, 2009, and what we were seeing back then. Big thank you to both of you for joining us and talking housing. We're going to be doing more when it comes to real estate a little bit later in the program. Oh, wow. So no time soon, Maddie. That's very, very sad.
I mean, isn't it supposed to get better over time?
Well, look, you talk to anyone, who's over the age of 50, and they'll tell you about the 17% interest rates that were in the 80s.
Right, there you go. That's true.
All right, you're listening to Bloomberg Business Week. We got more coming up right after this.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:21 on Wall Street. We do check markets all day long here at Bloomberg. Earnings, we just heard from Western Digital. It says it sees fiscal first quarter revenue in the range of $2.55 billion to $2.75. Now, the estimate was for $2.75 billion after hours. Looking at Western Digital, down now by about 1.8%. Another update for the U.S. stock market. The Dow, the S&P, NASDAQ all finishing in the green. It was a choppy session as we wrapped up the final trading day of the month, on to the trading month of August. S&P up 6, finishing the month at 45.88. A gain today of 0.1%. The Dow up 100 points, up by about 0.3%. NASDAQ up 29, a gain of 0.2%. 10-year yield 3.95%, with a 2-year that's yielding 4.88%. Spot gold up $6 the ounce to $19.65, gain there of 0.3%. And West Texas Intermediate crude oil up 1.6%, 81.85 a barrel on WTI. So again, recapping here an update on Wall Street. S&P up 6, a gain of 0.1%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Really appreciate that. Maddie, can I still call it Twitter? Is that allowed?
I can't call it X. And I mean, I know that it's incorrect, but right. I don't know how to do this.
I'll do this.
I can't do this.
The company formerly known as Twitter.
There you go.
Has reinstated the artist formerly known as Kanye West. Does that work? That's after an 8-month suspension.
I see a smile on Ed Ludlow's face as he's in our monitor here, getting ready for us to bring him in.
Ed Ludlow is the Bloomberg Technology co-host. We're also here with Bloomberg Intelligence senior tech industry analyst Mandeep Singh, because we're doing a tech roundtable. We're not just talking about Ye on Twitter. I don't think, last check, he hadn't tweeted. I don't know if he has. Ed probably knows that. And then we're going to talk some earnings and everything that we've seen so far, and then what we have to look forward to later in this week. Ed, I want to start with you and bring you in from San Francisco. Okay, do we care? I mean, I was in San Francisco actually back in December. I was seeing you, and when Ye was kicked off the platform,
right? And
he did some pretty horrible stuff. Swastika combined with the Star of David.
Star of David, yeah.
And Elon Musk is just letting him back on?
So let's state what we know. The account's been reinstated, but with restrictions. So it's not eligible for monetization, which means that, you know, Ye can't have a subscriber following in which you pay to subscribe for that specific account, which is something that X, the company and platform formerly known as Twitter, brought in. But what's really interesting as well is that the Ye timeline, the image of which you're showing on the screen now, won't be associated with any ads. So this is just one example. Like, do we care about Ye coming back? Well, what he did in December was quite egregious. And you know, I've covered Elon Musk for a while now, all those different companies. He's often inconsistent, right? But he has been consistent on this point that the tweets that Ye said, particularly that image combining the Star of David with the swastika image, was violation of Twitter, now known as X's rule against incitement to violence. And so he's back, but obviously it's got people talking.
Well, it makes me wonder, Ed, and I know that you are the expert on Musk's thinking here. This news that X is reorganizing the trust and safety team underneath Musk. Are we going to just continue to see more moves like reinstating Ye? And how predictable can those moves be, given what you were saying about his unpredictable behavior?
So when Elon Musk bought the company known as Twitter, now known as X, there were all these layoffs. One of the kind of areas where they cut back headcount was in trust and safety. And, you know, there's been a pattern in the months that have followed where, Elon Musk makes ad hoc decisions himself, policy decisions. Linda Yaccarino has come in as CEO, but she's kind of focused on the advertiser side of this business and communicating to the advertisers. It's still relevant, though, because one of the key things that they've done in their pushback against hate content or misinformation on the platform is they've basically gone to the advertisers and said, you need to be more selective in the content you want your ads to appear alongside. freedom of speech, but not freedom of reach. And the idea is that they're not worried about the volume of bad stuff on Twitter. They're just worried about the number of people that see it. And that's where they've gone to control it.
Well, it makes me wonder about how effective this entire rebrand is going to be. And Mandeep, I want your take on this, because myself, a lot of my friends, if we're using us as the market indicators that we are, we're not in love with the rebrand, and we're using Twitter far less, I should say X. What's the read-through on that to the overall marketplace?
Well, and you see that in the numbers, right? So when you look at the advertising revenue, even though Twitter is not a public company anymore, I think by all accounts it's dropped, and it's dropped meaningfully to the point of 50% ad decline. And we know from Threads launch, even though the engagement seems to have tapered off, they have 100 million monthly active users.
How much are they using it, though?
Well,
that's my question.
So, the thing with any new social media platform is, look, you go back in history when, Facebook or Instagram were launched, it took them a while to, build network effects, to have people engage more, and content is the pull that drives engagement. So with Threads, I think you have the signups now. They are adding more features. I think we've talked about adding a desktop app, or there are some frequently requested features. And to my mind, every point of market share that Twitter is losing is probably going to Threads at this point of time. And over time, you could see Threads' pace of new feature launches would be much faster than a company like Twitter, which is even struggling to keep what they had. I mean, the rebranding, I don't know how it helps you drive more engagement. Yes, it pleases Elon Musk, and it probably may help drive some more users just to get attention. But in the end, it's about content, and it's about features. And
there was this widely maligned tweet, Mandeep, a few weeks ago from Linda Yaccarino, the CEO, of Twitter, and she essentially said, what it's going to be, what's the product's going to look like. And it's, there were a lot of people who made fun of it with references to Succession and, what the Roy family was going to planning to do. And it just didn't make any sense. And I'm wondering if Twitter moves away from its core, does that actually give Threads an opportunity to come in and succeed where Twitter didn't? Because Twitter was by no means printing money over the last few years before Musk took it over.
Yeah, I mean, look, I think in terms of advertising revenue, given Meta's size, it's not as if, it's going to be a big contributor to its top line. But in the end, the way Meta is operating, and we saw that from the latest earnings, it's about engagement across its family of apps. And Reels is a product that cuts between, the Blue app. Everyone wrote it off. But guess what? They're able to grow both users and engagement on the Blue app through Reels. So that just goes to show the power of scale and, adding a feature that you can use across apps. That's what they're doing. They're using videos across a family of apps. Imagine a feature like that they uncover on Threads. They're able to roll it out across their family of apps. And that's where I think Meta has such a big advantage over all the social media platforms. It's their scale. Look at the infrastructure spend that Meta has in a year. That supersedes the entire R&D expense of all the other social media platforms. And I think that's an advantage that I think Twitter just gave kind of Meta a window of opportunity for them to launch an app like that. Right. That's why Meta didn't launch a Pinterest lookalike or anyone else. And I think it just happened to be the right time, for Meta to launch Threads.
Well, I do want to save some time in our conversation for a look ahead to some of these earnings. We've got Amazon and Apple coming up here. Ed, what is the key question that you're going to be asking on your show when it comes to what the earnings takeaways are going to be for these two huge names?
Yeah, a lot of the Amazon story is still like the unraveling of the pandemic era. Jeff Bezos invested as much money as possible to get your packages to you as quickly as possible. Andy Jassy replaced him as CEO, and we're still finding out what he is as a CEO, right? He was the AWS chief. AWS is the cash cow. And, we know from Bloomberg's reporting that he's gone to each of these units, Prime Video being the example, and said, hey, how much money are you guys spending? Like, for reals, how much are you spending? And reining it in. Right. So that, it's an interesting one because we know Amazon is Amazon.com, us the consumer, but, AWS and advertising is often the surprise in earnings time. But so too is just their scale. And then, for us on Bloomberg Technology, we're super hyped about Vision Pro, but it's a nothing product for the time being. Limited volumes, not meaningful revenue. So the iPhone is everything, and we want to know how that's going. And if you go on the Bloomberg terminal, whatever function you use, MODL or EEO, most analysts only expect the services and wearables top line to grow year on year, expecting a decline in most categories. So that sets you up for surprise, and surprises are fun. Like the iPhone could come to the rescue again, and I like stories like that.
Surprises are fun, Ed. I'm glad to hear you're optimistic.
We'll be looking forward to that one on Thursday. Mandeep, I want to give you the last word just in 20 seconds. I know you don't cover either of those companies specifically, but you by no means ignore them. What are you looking for from Apple and Amazon?
Well, Apple will tell us only their revenue for iPhone now. They're not going to tell us unit shipments, so you're going to know less about what's driving that iPhone growth. And to me, really, that's important, right? Is Apple gaining market share when it comes to units, or is it the ASPs that's driving all the top line? And look, buybacks is a big part of the story, so they will continue to be judicious with their capital allocation. But in the end, it's the iPhone that drives it, and they're telling us less and less going forward. So
Mandy loves surprises too, whatever he says.
Who doesn't love it? Who doesn't love a surprise? And we love it when both of you join us. Bloomberg Technology co-host Ed Ludlow and Bloomberg Intelligence Senior Tech Industry Analyst Mandeep Singh. Let's get to Washington, D.C. now for a check the latest world and national news. Nancy Lyons is in our 99.1 newsroom. Hey, Nancy.
Thanks, Tim. Paul Rubens, also known as Pee Wee Herman, has died of cancer at the age of 70. Who can forget that laugh? Rubens' publicist says the actor and comedian has been struggling privately with cancer for 6 years. In a statement released upon his death, Rubens says he, quote, loved you all so much and enjoyed making art for you. The latest defendant in the classified document case against former President Donald Trump has made his first court appearance. Bloomberg's Nathan Hager has the update from Washington.
Carlos de Oliveira's hearing at the federal courthouse in Fort Pierce, Florida, didn't last long. The property manager at Mar-a-Lago wasn't able to enter a plea because he hasn't yet found a Florida-based attorney. De Oliveira was added to the indictment against the former president last week in an alleged plot to keep top-secret documents at Mar-a-Lago and thwart government efforts to retrieve them. De Oliveira's next court appearance is set for August 10th. He's been ordered to turn over his passport till then and pay $100,000 if he doesn't show up. In Washington, I'm Nathan Hager, Bloomberg Radio.
Former President Trump continues to hold a lead over his Republican challengers in the race for the White House. A new Siena College New York Times poll released today shows 54% of likely GOP voters back Trump. Brown University's political science professor Wendy Schiller explains why Trump is still polling so high despite multiple indictments.
The Republican voters are treating Trump like the incumbent. They're staying loyal to him. And the opponents have not gone directly after him hard enough. Maybe Chris Christie, but generally speaking, DeSantis has held off, and that's been a mistake.
Wendy Schiller tells Bloomberg Trump supporters see him as a fighter. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
Yes, 4:40 on Wall Street. We do check markets all day long at Bloomberg. Among the names reporting after the close of trading today, Arista Networks. The company reported second quarter results that did beat expectations. It also delivered a revenue forecast that is above the consensus estimate. We've got peers Cisco Systems and Juniper Networks, both higher after ours. We close the books on the trading month of July, and it is on to August. Where is this year going so fast? Up 3.1% for the month of July on the S&P 500 index. On this final day of trading, stock traders did refrain from making big bets as concern about an overheated market resurfaced amid a rally that drove the S&P 500 to its longest streak of monthly gains since August of 2021. S&P today higher by 6 points, up by about 0.1%. The Dow up 100 points, up by 0.3%. NASDAQ up 29, a gain of 0.2%. 10-year yield 3.96% with a 2-year 4.88%. Spot gold up $5.50 the ounce to $19.65, up 0.3%. And West Texas Intermediate crude holding above $81 a barrel, up $1.28 today, up by 1.6%. So an update for the Dow, the S&P, and NASDAQ. But what about the market outlook? Vivian Hairston is Director of Portfolio Manager at Huntington Private Bank, and she was our guest right here on Bloomberg Business Week.
We are cautiously optimistic regarding markets. Really looking at the consumer remains strong, and so markets and the economy both, we're cautiously optimistic.
And you can hear more of that conversation on the Bloomberg Business Week podcast. You can download it wherever you get your podcasts. Again, recapping here, stocks higher with the S&P up 6, a gain of about 0.1%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right. Thank you so much, Charlie. I am so excited for our next segment because we get to talk about a dream that I think will never come true for me, which is owning a home in New York City.
Well, like a $7 or $10 million penthouse?
Right. I mean, I don't know. What am I going to do? Own like a weird studio?
You
like
never know.
I'm going to be 40 someday and I'm going to be in a studio, you know? But Tim, to me, you embody the classics of the American dream. You've got the beautiful family. You've got a home that you're quick to remind me is an apartment.
An apartment.
So it doesn't count.
We're quickly outgrowing it.
Yes, as you've got another baby there. But here to help kind of potentially crush our anxiety levels when it comes to the real estate picture, or fuel them, who's to say, is Francis Cadson, agent with Douglas Elliman. Francis has $3 billion in total sales, selling in excess of $350 million annually. So a great pulse on the market, Francis. Thank you for coming in studio with us. Talk to me about the outlook in New York City. Is there any optimism for me out here?
Well, Madison, I think it depends on which side you're standing on. I mean, I think that the luxury sector, over 4 million, is having the most fun right now, to be candid, because there's the most opportunity. When there's this unknown variable, there's a lot more negotiability. They're a little bit less dependent on any rate. They're exempt from it, to be honest.
Because they're paying with cash?
Correct.
Yeah.
And just to be clear, the 65% more cash deals that we're seeing are not necessarily because there's more cash deals. It's just that the mortgage deals that were happening have slowed down. So that 65% just looks front and center.
Like, it used to make sense, even if you had $7 million to spend on an apartment in cash, rates were so cheap, it used to make sense to actually take out a mortgage, because you could take out a mortgage for 2.5 to 3.5% and then throw that other money in the S&P 500 and, or do whatever you wanted with that other money. But now that's not the case.
So therefore, cash is king, because sellers are really wanting to take advantage of unloading the asset. They want to get out of New York, or they want to downsize, whatever it is. And this is the opportunity, because people have uncertainty. They're not sure. There's a malaise in the market. There's an unknown. Should I time it? But these ultra luxury buyers, there were 3 sales done over 50 million over the past week and a half. One in the West Village, one in Gramercy. It's happening. People are doing it big time on the 50 million plus. But it's the entry market that has the least to spend, the most to lose, and are the most impacted right now, in my opinion.
What does that even start to look like?
In what way?
Like, who can buy a home at the entry level right now? And
So I think it's
yeah.
for parents who can help bankroll the down payment.
Okay.
Because that's the most illiquid part for these buyers. They can probably manage the mortgage and the common charges if they can make it work with the relationship of a lender that can give them a little bit, like a quarter or a half a point down. But at the end of the day, people are having to grieve and say goodbye to 2.75 to 3.5% rates and get ready to take 6.8 to 5% rates, which is meaningful when you're carrying a certain income and you're hoping not to rent because you want to own equity. It's hard.
Francis, I mean, we've been talking real estate a lot this afternoon, but I wonder about just the lack of supply that we're seeing right now, and if the story in New York is at all different than the story in other parts of the country. And I go back to what Fed Chair Jay Powell said about, and this is for starter homes. I mean, there's new construction coming online. There are new developments happening all over the country because there's demand for them. We just don't have the space here in New York. We're not going to be seeing Lennar come in and build a bunch of homes, for example.
So here's what we're seeing. We're seeing bidding wars up 7.4% around the country, but we're not necessarily seeing it in New York. But because there's a down of inventory, it's about 23% down on inventory for under 4 million. We're seeing that change in terms of bidding war for the under luxury price point. Around the country, you're right. There is a level of need and supply and demand. New York, you're right. It's not getting any larger. But the problem is that it's so expensive. People can't make the numbers work. So New Jersey, Brooklyn, Long Island City become very interesting because people want to save. They don't want to burn it all out. But at the end of the day, people like to park their cash in New York City. It's a hub.
What are you seeing when it comes to foreign buyers right now? Have they dried up?
Big time. No,
Big time, really?
No, it's happening. I'm doing deals with Germany, London, Russia. It's happening, yeah.
Russia?
Yes.
Go into detail, please.
I can't. But suffice it to say, people want to get money out of certain countries and park it. Yep. And it's happening.
Yeah.
It's happening with Asia.
So I just want to make sure we're allowed to do deals with Russia. How does that work?
I'm not discussing anything other than to say it's happening.
Okay.
So, and how luxury are those deals?
We're talking 15 million plus.
Yeah.
There's a lot of discretionary income, but it's more than that. It's a hub. We have a very different tax allowance here than we do for the actual New Yorker.
Sure.
Go figure.
Yeah. What is that looking like in terms of the impact on availability of units for renters out there? Are we still seeing a lot of units that are sitting empty because...
So that's a really good question because last year in November, we had a vacancy rate less than 2.7% and rentals were up 40%. Now we're seeing the rents softened in the early part of 2023 because we expected a big sale push. But because the rate started to really impact that and the inventory was down because nobody wanted to let go of that really good rate that they had as a seller and have to take on almost double-digit carry, we sort of got back into the rental market. But the rental market went from 1 month OP again to now fully, no, we're not negotiating. But now, again, it's measured because parents are coming in and deployment of foreign investment coming in to offset that. So the rental market's moody.
We have 30 seconds left, but common charges are the killer.
Yes.
I talked to somebody, a colleague who's trying to buy.
Yes.
And they just can't make the numbers work because of common charges.
But is it the common charges or is it the combination of the rate? Because the rate was so artificially low, it offset the standard common charge of, $5,700 or $3,700, depending on the size,
just
or 20.
For the common charges.
Yeah.
Wow.
Common charges.
Maddie, are you optimistic?
I mean, it's not going to happen for me,
Don't say that.
I just think okay, what's happening with rent really quickly? Is my rent going to get any better this year? Next year?
It depends
Year
on what
after?
happens with the rates. I think that quarter-point hike sort of really pushed things over, even though inflation has steadily come down. So I think the rental market will adjust when we see rates adjust.
All right. Got to time the market, I guess, Tim.
Timing.
Francis Katzen from Douglas Elliman. Really good to have you with us this afternoon. You're listening to Bloomberg.
your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. The Walt Disney Company has hired Kevin Mayer and Tom Staggs, two executives once in the running to replace Bob Iger as CEO, to help it evaluate strategic partners for its ESPN sports networks. Disney shares today advanced 3.2%. AT&T's human resources chief Angela Stantone will be leaving the company at the end of September, just as the telecommunications giant is eliminating thousands of jobs as part of a newly expanded $8 billion cost reduction program. AT&T shares today up by 0.5%. Archer Aviation shares rallied 40.8%. Today it has agreed to build as many as 6 of its Midnight electric air taxis for the U.S. Air Force as part of a deal worth up to $142 million. And with more, here's Bloomberg's Dan Schwartzman.
Charlie, Archer says the deal marks an expansion of a 2021 partnership through the Air Force Agility Prime program. The electric vehicle takeoff and landing aircraft will potentially provide an alternative to helicopters for personal transport and rescue operations. The U.S. military has used Agility Prime contracts to back a range of manufacturers, including Archer and Joby Aviation, providing crucial support as the manufacturers work to raise funds, line up commercial customers, and bring their new designs to market. Joby expects to deliver its first aircraft to the Air Force in 2024. Shares of California-based Archer have more than doubled this year. Charlie?
And that's Dan Schwartzman reporting. Archer today up 40.8%. Joby up by 9.8%. Those are our top company stories. This is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
Hey, it's Bloomberg Business Week. Tim Stenevec and Madison Mills. Let's get a check-in on the latest world and national news. Nancy Lyons is in the Bloomberg 99.1 newsroom in Washington, D.C. Hey, Nance.
Hey, Tim. The property manager at Donald Trump's Mar-a-Lago estate has been ordered to turn over his passport, and he's agreed to sign to pay $100,000 rather if he does not appear in court. His next appearance is set for August 10th. Carlos de Oliveira did not enter a plea on conspiracy to obstruct justice or lying to investigators because he's not yet found a Florida-based attorney to represent him. Reporters quizzed his D.C.-based attorney, John Irving, outside the courthouse.
Has your client been asked to testify against Mr. Trump? I'm not going to go into Keep moving.
Attorney John Irving. A federal judge has dismissed a lawsuit that Donald Trump had filed against CNN. Trump claimed in the lawsuit references in news articles or by the network's host to his efforts to overturn the 2020 election as the big lie were tantamount to comparing him to Adolf Hitler. The former U.S. president had been seeking punitive damages of $475 million. Senior U.S. officials say President Biden has decided to keep the U.S. Space Command headquarters in Colorado. It overturns a last-ditch decision by the Trump administration to move it to Alabama. The decision ends months of politically fueled debate. Officials say Biden was convinced by the head of Space Command, General James Dickinson, who argued moving the headquarters now would jeopardize military readiness. Paul Rubens, also known as Pee Wee Herman, has died of cancer at the age of 70. Kids will remember him from Pee Wee's Playhouse.
Hello! It's time to play with your name. I'm going to sing a song, and whenever I sing, your name is... You say
Rubens' publicist released a statement from the actor while announcing the death, saying, quote, "I will always feel a large amount of love and respect from my friends and fans." He also apologized for not going public with his cancer diagnosis. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Now back to you, Tim and Madison.
Thank you so much for that update, Nancy. Really do appreciate it. A story we didn't get to last hour that we wanted to talk about this hour was about a company that's, a few years old. Let's call it 250 years old. Birkenstock. It's so hot right now.
It's really hot right now, so much so that the owner says they're planning a September IPO.
Did you notice that Margot Robbie was wearing Birkenstocks in the Barbie movie?
Oh, of course I noticed.
Did you really? Is
Yeah.
it pretty obvious?
Well, yes, and it's part of what's led to an increase in sales for Birkenstocks, which I think is hilarious because the whole point is like you can go to the real world and be a loser and wear Birkenstocks, or you can stay in Barbie land. And like that's led to a boost in sales for Birkenstocks. So I guess go off, I don't know why, but
I guess I got to see the movie.
I've never gotten on board with the Birkenstocks trend. Have you?
You know, I did have a pair
Yeah.
in high school.
They're
That's a
supposed to
weird
be
time have a
amazing,
pair.
like really comfortable.
Yeah, they're great. And it's just funny to see them come back. It was funny for me to see like all these kind of like hippie California things get popular.
Oh, yeah.
You know, like Uggs were big when I was in college, but when I was growing up, Uggs were like what surfers wore after they went surfing.
Weird.
Yeah.
Yeah. But I guess
you
that
know,
makes sense because it's
these
cold.
things have ups and downs
Yeah,
when
that
it
is
comes
so
to
true.
style. So
That's
it's
so true.
it's so funny to see that Birkenstock now is a company that could be valued as much as $10 billion. That's according to one of the people our reporters spoke to. The private equity firm